Hello and welcome to this educational video brought to you by Bayntree Wealth Advisors. My name is Christina Perez and I'm a financial advisor here at Bayntree. And today we're going to talk about traditional versus Roth IRA and 401k accounts. First, a general disclosure. This video was made for educational purposes only and should not be seen as specific investment advice. So to start off, what is an IRA? IRA really stands for Individual Retirement Account, and they were introduced for those individuals whose employer did not offer an employer-sponsored retirement savings plan, such as a 401k. So we encourage clients to consider contributing to an IRA in addition to an employer-sponsored plan if they have one available to them. The most common type of IRAs are traditional and Roth IRAs. These are the main differences between a traditional and Roth IRA. For a traditional IRA, the contributions are pre-tax, even though you're really making them with after-tax dollars, meaning the money that you receive as your take-home pay after it's already been taxed by your employer. So the way that it becomes a pre-tax contribution is by you reporting this contribution on your tax return and then receiving a deduction. So that's how, in a sense, it again becomes pre-tax. In addition, traditional IRAs grow tax deferred, and upon withdrawal of an IRA that's pre-tax, you will be taxed, hence why it's only tax deferred. With a Roth IRA, you put in the same take-home pay as an after-tax contribution, but because you do want to maintain it as after-tax, you would not receive a tax deduction when you contribute to a Roth IRA. So that is the main big difference for contributions. You would need to report traditional IRA contributions on your tax return in order to receive the deduction, whereas with a Roth IRA, you would not. In addition, earnings in a Roth IRA would be tax-free, so that's why the earnings grow tax-free. In addition, if the withdrawal is qualified, meaning you are over the age of 59 and a half in the 5-year holding period, then you would be able to distribute from a Roth IRA tax-free as well. And one thing to keep in mind, our contributions always come out of a Roth IRA tax and penalty free, regardless of your age. And going back to traditional versus Roth IRA contributions, for a traditional IRA, the maximum you can contribute for 2024 is $7,000 if you're under the age of 50 and $8,000 if you're over the age of 50. Contribution eligibility for a traditional IRA, it doesn't matter if you have high income. However, it will matter if you're participating in a 401k or if your spouse is, and that will determine if you're able to get a deduction for a traditional IRA contribution. So that's something to keep in mind. For a Roth IRA for 2024, max contribution is the same, so $7,000. Keep in mind, this is across, or that contribution limit is for both of these IRAs. So for example, if you wanted to utilize both, then you would only be able to put $7,000 total across the two. And in regards to contribution eligibility for a Roth IRA, there are income limits. So you want to be sure to check with your CPA what they expect your modified adjusted gross income to be. You really have until April 15th or whatever the tax filing deadline is of the following year to contribute for the previous year. So for those of you that might be near the phase out range or even in the phase out range, it usually makes sense if you're wanting to make Roth IRA contributions to just wait for the year to be over, work with a CPA to see what your modified adjusted gross income actually was for the previous year, and then use that to calculate how much you can contribute into the Roth. Again, for the traditional IRA, it's really more about whether you're able to deduct that contribution, and that has to do whether or not you're participating in a 401k. Withdrawals, as we briefly mentioned, for a traditional IRA, you will be penalized if you withdraw from the account before age 59 and a half. And that's really because they designed this account specifically for retirement, and that is why they provided all of the tax advantages. So they are trying to encourage you to keep it invested for as long as possible. Hence why there's penalties if you do withdraw before age 59 and a half. There are exceptions to those penalties, so be sure to be aware that you are able to tap into it for certain expenses, usually health or school or first home purchase related. And with a traditional IRA, when you reach the required minimum beginning distribution age, which until 2033 is age 73, then you will be required when you turn that age to start distributing a required minimum amount, which is calculated very easily. In the year 2033, that required minimum distribution age increases to 75. For Roth IRAs, as I mentioned, your contributions always come out tax and penalty free, as long as, and in addition, if you meet all of the requirements for a qualified distribution, which means you're over the age of 59 and a half, and you've had an IRA or Roth IRA open for more than 5 years, then your distribution should also be tax-free. And the nice thing about Roth IRAs as well is you will never be subject to required minimum distributions. And the way you have to think about that is with a Roth IRA, you paid the taxes up front. So that's the reason why they will let you keep the funds in there for as long as possible. One thing to keep in mind is if you pass a Roth IRA onto your heirs and they inherit it, they will be subject to required minimum distributions. But the good thing is the income that comes out of the Roth IRA would be tax-free. Whereas if someone inherited a traditional IRA, they would most likely be required to either deplete the account in 10 years or take annual required minimum distributions. And that income or any amount that comes out of that inherited traditional IRA would be seen as taxable income. So something to keep in mind for those who maybe want to leave IRAs to their kids. Now, what is a 401k? As mentioned, a 401k is an employer-sponsored retirement savings plan. It allows individuals to save and invest a portion of their salary regularly, and employers sometimes offer a match of those contributions and potentially even an additional profit sharing match that's typically based off the performance of the company. And you can invest a 401k in stocks, bonds, and other alternatives that are chosen by your employer. So a traditional and a Roth 401k contribution are going to be very similar to a traditional and Roth IRA contribution. So traditional, again, is pre-tax, Roth post-tax. And in regards to distributions, they would be the same, meaning the traditional IRA gets taxed on the way out and the Roth IRA got taxed on the way in. Therefore, if it's a qualified withdrawal, then the withdrawals are tax-free. And again, no mandatory withdrawals beginning at age 73 for Roth IRA or 401ks. And there would be required minimum distributions from a traditional 401k, very similarly to a traditional IRA. And diving into differences between traditional and Roth 401k contributions. Notice the significant increase in the limits that you can contribute to a traditional and Roth 401k. And similarly, this maximum limit of $23,000 for 2024 for anyone that's under the age of 50 would be across both types of contributions. So for example, if you wanted to do $10,000 in traditional pre-tax contribution and then $13,000 of Roth 401k contributions, that would be allowed. If you are over the age of 50, then you have a $7,500 catch-up contribution, so meaning you can contribute up to $30,500 for 2024. And in order to be eligible to contribute, you must be at least 21 years of age and work for an employer that offers this type of plan. And the time period to be eligible to contribute is actually going to depend on your employer and the rules that they set for the specific plan, which typically is at least 6 months to 1 year. However, some 401ks allow you to contribute the day that you get hired, so it varies by employer. Traditional versus Roth 401k withdrawals. I apologize for the typo here, but very similar again to traditional and Roth IRAs. So really just depends on your age and whether you've met the requirements for it to be a tax-free withdrawal from the Roth 401k contributions. And if you take from the traditional 401k contributions, as long as you're over the age 59 and a half, then you would only have to pay ordinary income tax on the way out. So key considerations for your 401k and IRA: really consider your investment strategy and understand the level of risk that you're taking and whether it is appropriate, one, for your risk tolerance, but also your goals and your time horizon. Number 2, evaluate your current income versus your future income. Think about your retirement goals and really what you want your retirement to look like and what type of lifestyle you want to be able to maintain into your hopefully late 90s. And also take advantage of employer match contributions. Some of these, regardless of you making a contribution, your employer would contribute, but there's other 401ks where they will only contribute if you contribute. That's where you really want to make sure you're taking advantage. Thank you again for watching this educational video. I hope you found it useful, and if you have any further questions, feel free to reach out to us. Take care.